me and Guru, we're going to talk about part 2 of the book, which is all about putting your hard-earned money to work. What is it of any use to make money, but not make it work for you? So in this, there are 5 chapters that we'll go through. First one is allocation model. How do you allocate your money? Where do you put it to work? Optimizing that allocation with various tactics and strategies. We'll talk about the most important piece, the real estate, and some fundamentals, and how living where you live has a huge impact on your wealth. It's chapter 8. And we'll conclude with going long on real estate and why, and if it makes sense. So with that, we'll get into chapter 5, allocation model.
Chapter 5 is all about the allocation model, right? You have, let's say you have $100,000. Where do you put your money? Where do you put some of it in index funds, some of it in real estate, and where in stocks and bonds, right? So it's all about that. What is that one thing that you took from this chapter? If you could highlight that one thing, and if you want to summarize rest of the things, that would be great.
Yeah, I think the biggest thing to take away is that there is a framework where we all need to build a framework for allocation model. Most people don't invest because it's so complicated, so they don't even start. So not only do we need to start, but we need to also invest, diversify across various assets, real estate, stock, bonds, risk-free, tax advantage funds, right? Municipal bonds. And we need to improve on investing in the pre-tax and taxable accounts. So that was the biggest takeaway for me, which is to know what percentage of my allocation is in a given asset class. And by age, how am I going to increase or decrease that based on my risk tolerance? So it was a huge revelation for me to first ask several questions like, what is my risk tolerance? Am I okay with being a risk averse person or being a risk neutral person? Or like what kind of risk tolerance do I have? And it depends a lot on the age. And so that was a key thing, which is I could ask myself better questions and then create a framework where I could, put numbers that says, hey, at age 30% of my, investments are going to be in stock, and then 30 in real estate, 30 in, something else. So that was the biggest one for me. What was your biggest one?
I concur with you. So if you bring up the snapshot for the allocation model by age, and the author goes about 3 different ones. This is the conventional one that we are showing, and then there's a middle ground, and then there is aggressive, right? So you will see this is a conventional allocation, net worth allocation. So at age 23, he rightly recommends that you go 100% into stocks and bonds, right? And then, well, if you do lose and if you do get into a bear market like we are currently, it's okay. You have the advantage of time, age, right? You can recoup everything, right? So, but then look at the allocation at age 40. This is a conventional model. This is pretty safe, playing safe kind of approach, right? You're just at 55% into stocks and bonds, but you are 40% into real estate and risk-free 5% and other things, right? So as and when you start aging, it'll start decreasing. The real estate start increasing, but again, if you look at the age as and when it goes up, again, he recommends the stocks and bonds increase here. So this was a good eye opener for me. Like, okay, real estate, how much should I put in if my approach is conventional model? How much should I put my percentage into the risk-free alternatives, right? This is a safe play model. Now, you got to figure out what kind of investor you are, and then figure out, okay, you are a conventional or more aggressive one, right? So that was my takeaway. I am a bit aggressive personally, so I would allocate almost everything into stocks and a little bit into real estate and a little bit more into cryptocurrency, the alternatives. Because I still believe I'm not in a wealth preservation mode. I'm still in a growth mode. So Yeah, this was a takeaway from me for me
Yeah.
from this chapter, right, Kunal? Yeah,
That's huge, right? Like knowing the percentage as you mentioned, and then you
yeah,
mentioned there's a conventional. So just to quickly give you an overview, conventional is one of the three types. There is a new age, and then there is a
yeah,
samurai, right? So
yeah.
in a sense, it's basically the percentages are changing, right,
Yep,
across each of these.
yep,
But yeah, if you can remember these two things, folks, which is like build a table like this that Guru shared and have some numbers in there that you feel comfortable, that you change over time. That's the biggest takeaway, right?
yep,
And stick to it. That was
yep,
another one, which was don't keep changing it because there is market cycles. If you
yep.
suddenly realize, oh, I want to do 50% when it was zero, and then it
Yeah,
go back to zero, then it's like you're just missing out on everything. So stick to
absolutely.
whatever model and allocation that you pick. That was
Yeah.
another.
Can I ask you a question, Kunal? What kind
Yes.
of investor are you? Where do you fall? Conventional, or the middle ground, or the samurai one?
The samurai one.
Oh,
I
cool.
have in my I'm exactly opposite of what the author is actually suggesting, primarily because
In what way?
in the real estate way.
Okay,
I
okay.
feel that the percentage for real estate for me is zero right now, and I
Uh-huh,
feel that that's the most aggressive for me and okay for me. And so I
uh-huh,
go mostly in stocks and
uh-huh.
debt-free and tax-free municipal bonds, and then
Okay,
treasuries.
that's
So these
cool.
are the three allocation that has 100%.
What about
That is
crypto? Do you have any alternatives?
zero. I didn't start. I never
Zero.
invested. Have
Oh,
no
really?
idea, and I think I'm okay with it without that party. So
Okay,
I'm okay with it.
okay,
Um,
cool. Yeah,
so
thanks
yeah,
for
just
sharing.
the stocks is the primary, and I've slowly started adding tax-free municipal bonds. That has been a huge second pillar, and
Mm.
just keeping money in the bank is paying 4.5% right now. So it's working fine.
Which bank is paying
Vanguard,
4 point?
just put it in Vanguard. You will get like
Oh,
the
okay,
Federal
okay,
Reserve is doing the work for
okay.
you with rate hikes.
Yeah, 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 yeah,
So
yeah.
just
I thought you were
money in
talking
the
about
bank.
high savings. Okay,
iSavings
you're
is another good one that you're talking
yeah,
about. It's a really good one.
yeah. Are you
So
talking
yeah,
about money market?
money market. Yeah.
Okay, okay, 4.5. Yeah, that makes sense. Yeah,
So that
thanks for
works out
sharing that.
fine. So that was chapter 5, right? Allocation. And then
Yep,
we want to go to next chapter, chapter 6.
yep.
All right.
This is
So chapter
about
6 is
yeah.
about like optimization, right?
Mm-hmm.
So where to not put your money is how we think about optimization. So Guru, what was your biggest takeaway in chapter 6 or
Yeah,
optimization?
it was where how not to lose money, where not to put the money, right? The author talks about the tax efficient investments and 401k, Roth IRA. The regular advice you will see, you will get from the internet and everywhere, generic advice, right? Like, yeah, max out your 401k, Roth IRA, and everything. That's everywhere. Everybody says that now. And then you invest some, if you're young, invest in growth stocks, and that advice you will get on YouTube everywhere. Nobody talks about where not to put your money, right? So, for example, this year, 2022, was all about where not to put your money, right? If you knew that, I think, at least if I knew that, I would have saved at least 30% of my portfolio. I went aggressive into some
Wow.
companies, and one of the company went bankrupt, which I lost quite a bit, right? So that's where I would not have put my money if I had learned this, gone through chapter 6 and really diversified a little bit more. That's my biggest takeaway. Like, for
So
example, yeah, go ahead,
yeah, like
Kunal.
what specifically in the chapter helped you that would have made you not make that like that mistake?
Yeah,
What
he
was
talks
that
about
learning?
limiting your portfolio
Mm.
to 5% to risky investments like multi-bagger investments. So if I would have stuck to that 5% of my portfolio, I probably be okay. It's okay. My 95% of my rest of the stock portfolio would have made up for the 5% loss eventually. That was my biggest takeaway here. And I've not done angel investing, but another takeaway from this chapter was about angel investing. It sounds angelic, like the name suggests. You feel good like saying, I'm an angel investor. But it almost means like you're giving away free money. That's it. You don't expect returns from that, right? He talks about an example where he get really minuscule amount of returns after I think 5 or 10 years of investing. He gives an example there in the chapter. You guys should read the book. You'll get to know. Right. That was the biggest takeaway. Where not to put your money. Right.
Awesome.
People. Yeah. That was chapter
So the top
6.
3 places in 2023 that you will not put your money is?
Um, Not put my money in loss-making companies, which have lovely story that they will grow big. Yeah, show me the money first. Bring in the money first, and then I'll put that. I will not put my money in altcoins, in cryptocurrency. And the third one, I don't know. I will put my money in index funds. I'm not a believer in index funds, but I'm starting to believe slowly.
Mm,
So 2 places I won't put, 1 place I will put.
nice.
That's
And
the
you also
biggest takeaway from.
mentioned
Yeah.
the 5% of not going beyond
Yep.
5%.
Yep.
You
Thanks
will
for
not put
reminding.
beyond
Yes.
5%, even
The
if you are
beyond.
super bullish. How do
Yep.
you
Yep.
really feel about that? Do you feel you like that idea, or is it like too limiting? I felt it to be too
It
limiting,
is
but
it is too limiting for our own good, I think. When this kind of market comes in, it really will save us. It's a safety valve
yeah.
for us. Yep.
Agreed. So yeah, I fully agree with you. Where not to put the money is the huge takeaway from this. And one minor point from my side would be max out before you do all of this adventure into where
Yeah.
not to put money. Max out your retirement tax
Tax.
advantage accounts first.
Yep. Yep. Yep.
Like
Yep.
if you are getting free matching with your employer,
Yep.
that's like
Do
free
that.
money, 100%
Free money.
return
Yep.
instantly. So you should
Yep.
probably do pre-tax,
Yeah.
lower your tax right away and do pre-tax contribution. And if you still have more after that, you should probably do post-tax and Roth conversion and Roth IRA. So that's a huge. And if you've not heard
Absolutely.
about backdoor Roth, I would highly encourage you, anyone and everyone can do that. I've been doing that for quite some time.
Oh, really?
Roth is a
Uh,
huge, your money grows tax free, and you can do backdoor Roths if you've not known about that. So tax efficient investing was the biggest takeaway to do on top of what you said of not to do, right? So that was
yep.
my
Yep.
biggest takeaway.
Yep. Yeah. That was pretty
Awesome.
cool in chapter 6. Yeah.
Now that we've talked about allocation models, how much and where to allocate, and we've talked about like what other strategies you have to optimize, let's now get into the fun aspect, real estate.
Real
So
estate.
chapter 7 is all about real estate, and let's kick it off with some fundamentals. What was your key takeaway, Guru, from this entire chapter? What did you
Yeah.
like most?
Yeah. Real estate is something I read this book after buying my second home. So I was really anxious about like some of the models that he speaks about, like for example, 30, 30, and 3, right? So he speaks about, if you can bring up that picture, Kunal, while I speak about this. My biggest takeaway from real estate fundamentals in chapter 7 is he talks about you you should have saved 30% of the home price, and you can only pay 30% of your gross income to your mortgage, and you should limit 3 times your gross income. The home price should be limited to not greater than 3 times. I think this is again a guardrail that he provides for most of us investors, because it's so difficult to understand, hey, how much can we really pay, right? How much can we not pay? Because how owning a home is not just about paying the mortgage, right? Not just the principal and interest. You have to pay the taxes. You got to maintain the home. I can give an example. Like just after Christmas, there were heavy rains here in Seattle and snow. Um, and my fireplace chimney started leaking. So I got to get that repaired, and it costed me about two thousand something. for somebody to come and fix the leaking chimney because otherwise it is going to flood the living area. It will cost me more money. I'm like, okay, 2000, fine, that's fine. And the Happy New Year, the first day, my water heater broke down. It's the dead of the winter in Seattle, and you absolutely require a water heater.
Double
Eh,
whammy.
Double whammy, right? So I'm giving this example because it's not about just paying up your mortgage, right? And water heater costs, replacing cost another $2,000, right? And who knows? But if you're renting, you just call up your landlord, like, hey, chimney is leaking. Hey, water heater broke. It's their headache, right? So it looks rosy if somebody wants to own up the real estate, but of course there are perks to it. But it's not headache free. There are limitations to it, right? So if let's say if you don't go by this 30-33 rule, and you bought a big home with a big mortgage, right? You won't have any money left on a monthly basis to make repairs for the home. So this was my biggest takeaway. Like, yeah, sure. This 30/30/3 rule really makes sense, and it's very essential for folks to understand this. And another thing that he highlights, I loved it, is BURL, is buy utility, rent luxury. He he talks about, he gives an example like, yeah, if you want a luxury car, yeah, you buy a Honda Civic, rent a Ferrari. Makes sense. Rent it over the weekend. The same thing can go for a home as well. If you want to really live in a big home, probably you just rent it and you can't maintain it. You don't have to, you just get out of it, right? There is no obligation for you to continue paying the mortgages. I really loved that. I wish I knew that before. Right. So, yep. Yeah.
That's huge, right? From someone who owns a real estate,
Yeah.
you could really understand what it really means, because there are many costs. You
Yep.
just mentioned maintenance as a
Yep.
surprise cost
Oh,
that
yeah.
can happen at any time. And then
Anytime.
you need insurance. You probably need to pay property taxes,
Yep.
and on top of all of the mortgage payments that you need to be. So be very sure when you buy this real estate that you have done the fundamentals right,
Yes.
in terms of knowing what you're buying and having various scenarios, like what can happen, and
Yeah.
what can happen to your job, what can happen if there is like an
Yeah.
earthquake. You need to be having insurance, you need to have some money saved in, because as Guru mentioned, there are like several costs associated with it. But you didn't
Yep.
mention any of the perks. I just heard the downsides. What's the fun part, Guru? You didn't mention the good part.
You build equity, right? Your home value increases, and actually, this is not spoken about in the book, but there are perks. Since you're speaking about perks, right? It If you are someone like me who would have some surplus account amount in your bank account, then you would take that and try and invest in stocks or cryptocurrency. But then if you have a bigger mortgage, that money is gone towards the home. So then your money is limited to play in the risky assets, right? That is, I think, is a perk for someone like, okay, you have a home and you're paying towards the home. That much money is gone into the mortgage. That is one perk. And then, yeah, and then we started off small with a condo, and then we moved to a bigger home. So
Yeah.
it comes without with it does not come without headache. Again, things break in the rental home as well. You got to fix it yourself, or call a handyman, and things like that. Yeah, pros and cons, you got to balance it out.
Wow.
It depends on a lot of things, because it depends on your tenants, it depends on your neighbors, it depends on the locality and everything, right? So if you get tenants from hell, of course, you're done. And if your neighbor is not cooperative with the tenants and everything, that's another problem, right? So it really depends. Yeah.
Yeah, totally. That's the right answer. It depends on certain factors. So that
Yeah,
is real estate, folks. As Guru mentioned, there are various ways to get started. Condos, as he shared in his example, is the easiest, fastest way to get into it.
sure.
And then, build equity, and then you can go to multi-tenant, multi-utility homes, and then eventually
Yeah,
single-family homes. And you get the benefit of building equity. You're going to save a lot of money on tax as well,
We'll
and
see.
business income and business expenses and all of that, which is a separate topic. But yeah, so real estate, do your due diligence. Remember the 30-33 that Guru shared was huge, right? And then buy utility, rent luxury, right? So that's
Yeah.
another major one. Awesome. Cool. That's
Yeah.
chapter 7.
Yep, that was chapter 7. That's a good wrap of chapter 7. Chapter 8 is about where to live and how do you maximize your income, right? So what's your takeaway, Kunal, for chapter 8? What's your opinion?
And if you maximize the money that you make, then everything starts there, which is like you will be able to save more, you'll be able to invest more, you will have all of these ideas that become relevant because you have money to put it in your pre-tax account or your rental property or your real estate. So
Yeah,
where to live has a huge impact. So because if you figure out the industries that are relevant to your skills and then figure out where is the epicenter
yeah.
for those industries, where maximum number of those companies are belonging into that industry. Let's take technology.
Yeah.
So there are several really good hubs for technology. If you think about United States, there's San Francisco, there's Seattle, there's New York, there's Austin's
Mm-hmm.
coming up, several of them. But if you are in the epicenter of that technology, then you will have choices. You will have bargaining power in terms of the money that you make
Mm-hmm.
because you are in control. So income maximization was the biggest thing
Yeah.
that we should focus on when it comes to where to live in the early part of your career. So figure
Yeah.
out where are those high paying jobs
Yeah.
that you like to do, and where can you get promoted faster,
Yep.
because those companies will look at the effort that you put in and will reward you for that effort. So people do question post pandemic, how relevant is it to live in an expensive place like San Francisco? I think it's
Yeah.
super relevant, or
Yep.
Seattle for that matter, super relevant. If you're not in the epicenter, some of these shifts may be yearly shifts, but
Yep.
you got to be where there is maximum scope
Yep.
to increase your income. That was the biggest
Yep.
takeaway, because that's where
Yeah.
everything starts. If you
Yeah.
There's a limit on how much you can save, how much you can cut your expenses, but that's a limiting factor. But you need a
Yeah.
certain basic, but the only thing that you can control is how can you get the higher paying jobs, and how can
Yep.
you get more marketable and sell your skills in the best way, right? So that was my biggest takeaway.
Yeah. Very,
What
very
was
well
yours?
put.
Did you want to add anything to it?
I would second everything that you said, and I would say, hey, you are a person is an average of people around them. So, right, so if you are in tech and where the action is in, let's say, Silicon Valley, SFO, San Francisco, right? And if you're there, obviously you will look at other people and then you try to catch up to their level of capability, and then you'll be average of people around you, right? Yeah, you got to be in where the action is for your skills. Like if you are in investment banking, I would say, yeah, sure, New York, right? Yeah, if you are in tech, it's on the other side of the country. Yep, I agree with whatever you say. That was nicely put, Kunal. Yeah,
Yeah. So remember that, folks. Income, maximize your income. Start, maybe one small strategy could be start with the place where there is maximum income, and eventually once you are in demand and your skills are built and you have experience, you can negotiate and move out to some cheaper place. But start with where the action is, right?
yeah,
That concludes chapter 8, and then chapter 9 is again real estate. As
yeah.
to the author talks about going long on real estate and introduces several new concepts. So, Guru, what was your takeaway from chapter 9 on going long on real estate? And
Yeah, one takeaway is the valuation of the real estate, how much you pay, was the biggest takeaway for me. I think you make money in real estate when you buy the property. It's not about long term, right? When you say like how much you pay for the property is when you make the money. Let's say if the property is worth $1 million and you pay 800K, right? You made 200K there, then and there, right? So that's where you make the money. People think, okay, it's worth 1 million, let me pay 1.1, and it will be worth maybe 1.5 in maybe 6 years, sure, that is in the future. Who knows what's going to happen to that property, right? But upfront, what you pay is what you make right there, right? That was my takeaway from the valuation of the investment property. He talks about crunching some of the numbers. For example, he takes a ratio that is commonly used for valuing stocks, that is PE ratio, price to earnings ratio. If you are going to rent out on a property that you're looking for a rental property, he talks about, okay, what is the price that you're paying in what is the earnings, net earnings that that property is going to bring you in after all the expenses, right? After the property taxes, mortgages, and everything. And also assume that it's going to be vacant for maybe a couple of months a year or 1 month a year. So after every deduction, you will have some earnings for that property, and then what is the price, right? Price to earnings ratio he talks about. That was pretty interesting. I've never seen that PE ratio being applied for a property as well. And what are the rental expectations and every other metrics for real estate without getting into the details. One interesting thumb rule model that he gave is you got to buy the home for 100 times the monthly rent, then you would be safe. Like for example, if it's renting at $5,000 per month, you gotta pay about 500K for that property. I think that made sense, right?
And is it really possible, like to get
Uh,
a property that for
yeah,
500,000 that pays you 5,000? It's like
yeah. It's a
impossible,
pipe.
I feel.
It's
Do you think
it's
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 possible anywhere in the
maybe
United
in
States?
the Midwest. I
5,000?
think.
Someone will pay you 5,000?
Well, not 5,000. Let's talk about, let's say, $2,500 rent, and then you will probably, I think, get a home for about 300, 350. Again, I'm not an expert in real estate or anything, but again, it's just my research and based on my data that I have. Well, if you look for something that fetches $5,000 per month in San Francisco, and then if you're expecting 500K for that property, good luck. Right. So this is something that you can apply maybe in the Midwest, I think. Maybe
Yeah.
not. I don't know. With the after the pandemic, maybe even that's not possible.
Yeah, I
Uh,
think when I
yeah.
was reading this, this was the most contentious for me because 5,000 a month on a 500,000
Yeah.
mortgage is like 12% cap rate.
Yeah.
I feel that it's impossible to get
Yeah.
that high.
Yeah.
And so maybe it's too aggressive,
It's
especially
too
in
aggressive.
SF. It's like I've not seen such a property.
Yeah.
Not even
Yeah.
so I feel that this may need some revision in some way, is what my take is. Even in the heartlands, I like
Yeah.
what you're saying, which is like you can get something for 300,000, but then I have not seen it go beyond 1,600 rent. Like so, for several properties that I have seen, have you come across any such property? I would love to buy that.
Yes, I would definitely recommend rental properties, especially the smaller condos, which at least has a 2 bedroom and 2 bathrooms. You around the location matters again, right? If there's more crowd coming in because of schools or some companies, then the chance of it being vacant is very low. I would definitely recommend. You got to be careful. See what rent you get, and how much you pay for it, right? So at least most of the mortgage, if not everything, is covered by the rent. And at some point, you will break even and you'll start seeing positive cash flow. I would definitely recommend. Yeah.
Wow, that's awesome. And the reason why you say that it's a good thing is, did you just compare 5% to, risk-free 4% or something like that? Or how do you make a decision whether it's good or not?
It doesn't matter where the market goes, and it's something that you can sleep well at night thinking, tomorrow it's still the same rent that you will get, right? You're not too worried about, oh, if you have put your money in Tesla, is it going to go down another 7% tomorrow? Or maybe 10% up tomorrow? Who knows? I don't need that excitement, right? So it's a constant multiplier, right? So that's why I got attracted to that. Yeah, yeah.
Awesome. Are you gonna keep doing this more? Meaning just
I
keep
think
getting more.
so. I think I got to recover from the 2022 bloodbath. The bear market. Once I have some dry powder accumulated, I will definitely explore some of the condos near home where I stay to rent out for sure. I will do that personally.
That is
Yeah.
awesome. All
Yep.
right, so that is a wrap. We've completed entire part two. So
Part
now
two.
what we'll do is we'll do a quick recap of the things that we've covered in part two. So part two was all about putting your money to work, right? And we had 5 chapters. We went through how and where you put your money in build an allocation model so that you put your money to work in the right way and you have clear visibility, optimizing your investments and allocation, real estate fundamentals, right? We've learned from real experience on some of the key things to keep in mind, where to live to maximize your income, and going long on real estate. So let's get into and quickly recap this. So chapter 5 was allocation model. So Guru, you want to go through them for us?
Yeah, sure. It's mostly about the net worth allocation, how much, according to your age, where do you put your money? Stocks, bonds, real estate, risk-free alternatives, and all about maximizing your tax advantage accounts. And most importantly, know your risk tolerance, at what stage in your life you are, and be consistent, all right? Don't keep moving for funds from one investment to another. And at least be neutral. Real estate at least means that have buy a home, if not have multiple properties to rent. So that is when you are first time buyer and you have a home, that's called neutral real estate according to the author. So yeah, that's about chapter 5.
Awesome. And then chapter 6, we talked about where not to put your money along with
Mm-hmm.
where to put your money, right?
Mm-hmm.
And so where do you really want to put your money first, if you have the money, is tax efficient investment accounts, which is your pre-tax 401ks if you're offered with your employer. If you don't have an employer, if you're self-employed, you can do solo 401k. There's so many ways in which you can do tax efficient investing. So Google that, go into depth, or better yet, read this book. This book is really awesome. So tax efficient investing is number one. Max out your pre-tax 401k accounts, do the Roth account and IRA, backdoor Roth. Google that. You can easily get a Forbes article or a New York Times article on how to do that. Invest in passive funds, right? The vast majority of active fund managers really don't beat the index. So start there. And then once you feel comfortable, I've seen some cycles, then you can build some understanding of how to actively invest, and maybe don't put more than 20% in active securities. And growth stocks are the starting point, which will make it much more efficient for you to invest in a tax efficient way as well. And then eventually, as age goes through, do dividend investing. Avoid, as Guru mentioned, angel investing. You have no edge. Most people don't have any edge. There's no liquidity. There's zero, edge that each one of us
Edge.
has, as I mentioned. And there's no, you'll be diluted in terms
Yep.
of new funding
Yep.
rounds. So don't put more than 5% in any of these of your total net worth, and even your speculative ideas less than 5%. So that's chapter 6, and then chapter 7, Guru.
Yep, this is about the real estate fundamentals. I really love the way that the author puts the 30-33 thumb rule. 30% you need to be saved of the home value of liquid cash, and 30% of your income in mortgage, not more than that, of your gross income, not after taxes, right? So, and the home value should not be more than 3 times your gross income of your home, including probably if your spouse is also earning, right? And I love this fact, the Burl, buy utility, rent luxury, again, buy Honda Civic, rent a Ferrari. So that I love it. That's something that I really took away from this chapter. Some of the other things about real estate that he talks about is refinance mortgage. If you break even in less than 18 months, take it with a pinch of salt here, or grain of salt, however they say here. Um, um, because if the interest rates are higher, like where we are compared to 18 months ago, it doesn't make sense to refinance mortgage, right? So yeah, don't do that. When the book was written, obviously the interest rates were low, so it was consistently falling. So I think that's the experience that author has, and he's written it. A few other things quickly talk about. I'm going to the last point is the entrepreneurs get a mortgage before you become an entrepreneur. I think that's a sane advice
Yes, that was a
because
huge, huge advice.
yeah, right. So you some of the money will automatically go into the building the equity in your home, and then you have a place to live. Because entrepreneurship is very risky. I am not an entrepreneur. I have not done it, but it does feel like okay, only 10% of it of the entrepreneurs are successful, right?
Yeah,
So you got to be careful there. And a couple of other things that he's mentioned is mortgage free and debt free when you no longer want to work. That was like a dream, right? Like no debt, no loans or whatsoever when you retire. That automatically improves one's health, I think, at old age. So yeah,
absolutely.
yeah,
Yeah, and then in this piece of the being entrepreneur was if you decide to leave your job, you will not get a mortgage because they will absolutely deny it unless you have like all the savings in your bank account because they consider you as high risk when you don't have a steady pay stub, which was huge. So if you're an entrepreneur thinking
yeah,
of leaving
yeah,
your job, get a mortgage first if
yeah,
you really, and then switch.
yeah.
So that was chapter 7, huge, huge learning.
Yep.
And then let's go to the next chapter, where to live,
Where
right?
to live? Yeah.
Live where you can get paid the most, full
Yep.
stop, right?
Yep.
And
Yep.
whichever industry you're in, figure out where's the epicenter, figure out where's the maximum concentration, and go there. There's a limit on how much you can save
Yeah.
and how much you can cut your expenses, but there's no limit on how much you can get paid, and you can
Yep.
keep getting paid, promoted, be rewarded for your work. So go where you
Yep.
can maximize your income. um, and if possible, as Guru mentioned earlier, buy a neutral real estate, live in it for a few years, eventually rent it out, as Guru shared in his personal experience. That's huge because you build equity, and now someone else pays for your um, for your rental income,
For
right?
yeah.
And so work from home pandemic doesn't really shift things. It's just a few years, but it's
Yeah.
never really going back, I feel, in terms of everyone going back full time when there's no need. But these trends on productivity has a huge impact when you're
Yeah.
working from home or from not working from home or being working together.
True.
So keep that in mind. Unless you are super high skilled and unless you are in such high demand and you can work independently for most part, this is something you want to really carefully think about. Um, Type of home, as Guru mentioned, start with condo, easy to get in, eventually multi-tenant, eventually then single family. Uh, Start with the most expensive city where your industry is. It'll be hard initially, but then eventually gets better when you start saving more and making more money. Eventually, you can relocate to wherever it's reasonable, right?
Mm.
There's a reason why it's expensive in that city because there's a higher demand for those places to live because people are getting paid more there. That's the reason why it's expensive. So it's counterintuitive. Don't do that. Go to the place where you're going to make most money. So that's chapter 8. And to conclude, chapter 9.
Yep.
Guru?
Yeah. The author talks about going long on real estate, right? At least start with being a neutral real estate owner, investor, right? Real estate, he talks about as being a career insurance for you and your family. If you have a place to live, let's say you don't have a job, you can still go back home and you have a roof on your head, right? Emotional security to know where you'll be able to live. If there is real estate and let's say if it is paid off, that's my dream, right? It's such a huge security for you and your family. And he talks mostly about the post-pandemic trend about heartland investing. Like he talks about not the coastal cities, like not New York or Seattle or San Francisco. He talks about, let's say, Midwest, where you can invest in some of the up-and-coming areas, like in Texas, right? And Arizona. I think there are a couple of cities where it's really up and coming. Those kind of cities where he talks about investing more. Um, and Yeah, on vacation properties, he speaks about, what's the thumb rule of how we can invest in vacation properties. And he really recommends, if you have the energy in your 20s and 30s, you can build a rental portfolio. Like, it's not for everybody. A lot of people say, hey, I don't want to be a landlord. It totally makes sense. You don't want to have that nuisance in your life, right? The biggest takeaway, at least for me, I would like to highlight it again, is you make money on that properties when you buy the property. That's because of the valuation of the investment property, right? You crunch the numbers. If it makes sense, buy it. Otherwise, take the emotion out of the property and don't buy it. Right? If you go by the author's thumb rule, I don't think you will go wrong. It's really great guardrail that he's put when you invest, like 1% rule, and you pay 100 times the rent that the property fetches. Right? These are great points. You should read the chapter a little bit in detail about how to go long on real estate. Yeah.
Super. So that concludes part 2.
Part
We will
2.
see you in part 3.
Yep. All right.
Awesome.
Good luck, folks. Yeah.